Hi, welcome. My name is Priyanka, and a brief background about me. So, I have an experience of around 9 years in the banking and fintech sector, and I'm a pass out of IIM Calcutta. So, this is the first video in a four-part training series on financial statement analysis for supply chain finance. This series is built specifically for relationship managers, whether you are working at Trades platform, a bank, or a NBFC. The idea is simple. Before you pitch any SCF product, you need to be able to read the client's financials and understand where their cash is actually stuck. So in this first video, we are going to cover the three core financial statements. So that is the income statement, the balance sheet, and the cash flow statement. I will tell you what each one means and, more importantly, what each one tells you as an RM when you're looking at a client. Let's get into it. So before we actually deep dive into the statement themselves, let me explain why this matters. So most RMs in supply chain finance are trained on products. They know what trade is, they know what dynamic discounting is, but when they sit in front of a client, they are going from the client's ask. That is, the client says, I need a limit of 5 crores, and directly they go to a product recommendation. Now that's a problem, because the client's ask and the client's actual need are often very different things. So financial analysis is what bridges this gap. When you read a balance sheet properly, you can see exactly where the cash is stuck in the working capital cycle. And when you know where the cash is stuck, you know which product to pitch. So not by instinct, but by evidence. So there are 4 things financial analysis does for you as an RM. So one is like assess their financial health. You understand if the buyer has that balance sheet strength to support the supply chain finance program. Okay. Then you can make an informed decision beyond your intuition, actually, using their operating margins, using their leverage ratios. Okay. So that helps you to build a data-driven credit narrative. Next is your risk management. So if the buyer is over leveraged, then it becomes risky to the platform, right? You know which warning signals to catch early. So if there is a deteriorating days sales outstanding, or if there is a rising days payable outstanding, or if the current ratio is less than 1, these are all the stress signals before you approach a client. And fourth, which is the right size the product. So this is the big one. Okay, so you match the which product to pitch to the client, whether it's a trades or dynamic discounting or factoring, basis the actual funding gap in the working capital cycle, right? Okay, so all right, now we will go into these 3 financial statements that every company produces. So one of these statements will actually answer a different question, and let me walk you through all these 3. So the first one is your income statement. The income statement, which is also known as the profit and loss statement or P&L, it measures the profitability over a period of time. So when I say a period of time, it can be a quarter, it can be a full financial year, or a half year, right? So it actually tells what the business, if the business is making money or not, and how the structure flows. It is, you start with the revenue, then you subtract the cost of goods sold to get gross profit. Okay, then you subtract the operating expenses to get EBITDA. So EBITDA is your earnings before interest, tax, and depreciation and amortization. Then you subtract the depreciation to get EBIT, then the interest to get PBT, which is profit before tax, and finally you remove the tax to get to PAT. Okay, so what is the core question the income statement answer? That is, if the business is actually making money or not. And in supply chain finance, If there is a thin EBITDA margin or if there is a declining PAT, it is a stress signal. It tells you that the business is under pressure, and that will affect how aggressively you should structure a program or not, right? The second is your balance sheet. Now, while income statement gives me the entire picture over a period of time, balance sheet will only give me a snapshot. Okay, it will not tell me what happened in an entire period, but it will tell me at that particular date what is the position of the company. Okay, so it tells what the business owns and what it owes on a specific day. And in balance sheet we know there is one fundamental equation, that is your assets is equal to your equity plus liability, right? Everything on the left side is funded by something on the right side. Okay, so I will go deep dive into the balance sheet in my subsequent slides. Okay, the next is your cash flow statement. Now, what does my cash flow statement tell? By the way, let me tell you, this is the most important statement that most of the RMs ignore. Okay, and it is actually the most honest statement of all the three, because a company can be profitable on paper. The company is doing sales, it is earning profit, but actually it can be starving for cash, right? Because revenue is booked when an invoice is raised, not when cash is received. Fine. And my cash flow statement will tell me if the company is actually having cash to run the business or not. Now it again has three sections. So one is your cash flow from operations, which is your day-to-day business. Then is your cash flow from investing, which covers your capex and assets, sales, or if you're buying them. And next is your cash flow from financing, which covers if any loans and equities are paid or raised. And what is the core question it answers? Is this business generating real cash or not, right? So if you have a positive cash flow from operations, means the business can fund itself from operations, and that is healthy, right? So going a level deeper on the income statement. Okay, so as I said, the structure is from revenue subtract COGS, you get gross profit, then you subtract the other expenses like the employee expenses or the operating expenses. What does your operating expenses contain? Your transportation expenses, maybe your advertisement expenses, the other expenses. Okay, and you get your EBITDA, that is earning before interest, tax and depreciation. And finally, after subtracting your interest, depreciation and tax, you get PAT. Now let's talk about what are the important profitability ratios that we can derive from the income statement analysis. Okay, so first is your gross profit margin. What is the formula? That is your gross profit divided by revenue into 100. So what does it tell me? It tells if the business is operationally efficient or not, if the core business, okay, which is how much margin survives after the direct cost of producing or sourcing the goods. Fine. Next is my EBITDA margin. Again, the formula is EBITDA divided by revenue into 100. Okay, so this is the cash generation before capex and debt service, and this is the number most banks and credit analysts look at first. Okay, so a healthy EBITDA margin means that the business generates real operating cash before non-cash charges. The next is PBT margin, which is profit before tax divided by revenue into 100. Okay, this tells me how much the debt burden is eating into the margins, because I'm removing interest, right? And then I have my PAT margin, and that is what's actually left for equity holders, right? Now the most important ratio is your interest coverage ratio. And what does that tell me? If the company is generating enough profit to service or pay its interests, right? So the formula is EBITDA divided by interest expense, that is the profit generated from its core operations divided by interest expense, or a more conservative formula will be EBIT divided by interest expense, because I'm also removing my taxes, because taxes are something I have to pay. So I'm doing it EBIT, which is interest before earnings before interest and depreciation, EBIT divided by interest expense. Okay, and this is the most critical one, as I said. So for example, if my EBIT is say 100 crores and the interest expense, okay, the interest which I have to pay on my loans, debt, is say 20 crores. Now what is my interest coverage? It will be 100 divided by 20, which is 5. So what does it tell me? That the company is generating 5 times the operating profit of its interest expense. It can cover 5 times its interest expense, right? Now suppose if a company say is generating an EBIT of 20 crores and it has to pay again an interest expense of 20. So what is my interest coverage? It will be 1x, right? So the company is just there to pay its interest. Now if say the interest expense is say 20 crores but the EBIT is 5 crores, the ratio is even lesser than 1, right? And it tells me that it is not generating enough operating margins to even pay its interest, and that's a red flag. That's a big red flag. Okay, so first we need to check whether a company can pay its interest or not, and only then you will give a further say loan, right? Okay, so let's move to the next financial statements, that is your balance sheet analysis. Okay, so let me walk you through both the sides. As I said, here the equation is assets is equal to equity and liabilities. Assets is something the company owns to generate its business. Equities and liabilities, that something the company owes, which it has spent to generate these assets. Okay, so on the asset side we have the current assets, okay, which includes your inventories, trade receivables, cash and bank balances, short-term investments, and some other current assets. Okay, and then so current assets is anything which is within a year, any asset within a year. Non-current assets, anything beyond a year. Okay, so for example, plant and machinery, capital work in progress, long-term investment. So if a company is investing in mutual funds, say for a period of 3 years, it will be under your non-current assets. Okay, so on the equity and liability side, there are two components. One is your equity, which is your share capital plus reserves and surplus. Okay, whatever investors are putting money, whatever the promoters are putting money, will come under your equity. Then whatever profit you're generating and putting back again into the business will come under your reserves and surplus, right? Next is your liabilities. Again, here we have the current liabilities and non-current liabilities. So any liability within a year is under your current liabilities, like your short-term borrowings, your trade payables, and maybe there are other current liabilities Okay, and then your non-current liabilities, anything which is beyond a year, so like your long-term borrowings, deferred tax assets, or sorry, deferred tax and others. Okay, now let's get into the important ratios that we have here. So talking about the liquidity ratios, so we have current ratio, quick ratio, and net working capital. So what is current ratio? Current ratio is your current assets divided by current liabilities. Okay, so anything beyond 1.3x is something which is considered better. Anything less than 1x is a red flag, which means that if a company goes into solvency, its current assets will not be sufficient to fulfill its current liabilities. Okay, next is my quick ratio. So what is the difference between the quick ratio and current ratio? Is that I'm removing the inventory from current assets. And why am I removing the inventory? Because it is something which cannot be quickly converted into cash, right? Because it takes some time to convert the inventory to produce or to make it a product and then sell and then receive cash, right? So I'm removing that divided by my current liabilities. So anything which is more than 1 is preferred here, less than 1 is a red signal. Next is my net working capital, which is your current assets minus current liabilities. Again, it is similar to the current ratio, right? So if my net working capital is positive, it is good. If it is a negative, that is my current ratio is less than 1, it's a concern. Okay, now coming to the leverage ratios. So the first is your debt to equity, that is how much fund is taken from the market, right, is raised from the market, to how much fund is actually from the shareholders, will give me my debt to equity, right? So anything which is less than 2 is preferred, right? More than 2 is a bit risky, that is the debt is double that of the equity, right? Next is your TOL by TNW, which is your total outside liabilities divided by your net worth. Net worth is again your equity minus your intangibles. Okay, then so here again, anything which is less than 3x is generally considered okay, but however more than that, we consider the company as very over leveraged, right? Next is again the most important ratio, that is your debt service coverage ratio. Fine. Now similar to my interest coverage ratio, here there's an extra component that we are trying to understand if the company is able to service or not, which is its principal repayments. Okay, so the formula is your EBITDA divided by interest plus CPLTD. Okay, now here again we can on a conservative basis take EBIT divided by interest plus CPLTD. Now what is CPLTD? It is my current portion of long-term debt. Okay, so when I say current portion of long-term debt, what do I mean by that? So for example, if a company has taken a long-term loan of 100 crores for say 10 years. Now each year say the repayment is 10 crores. Okay, so in 10 years it'll repay the entire principal. Fine. So for the next year, what will be my repayment? It will be 10 crores, because every year I'm paying 10 crores, right? Now I should check whether the company is generating enough margins, profitability is generating enough profit to fulfill the interest and also whatever is the recent principal payment. Because if I only pay interest, that will not do, na? I'll also have to pay the principal amount. So is the company able to fulfill its interest and principal payments both? Okay, so that is my debt service coverage ratio. And where can I find this CPLTD? It is also mentioned in the balance sheet. Okay, so it will be mentioned under your short term borrowings. Okay, the next is my working capital ratios. So working capital ratios, as in to find out what are my inventory days, my receivable days and payable days, and finally to understand what is the working capital cycle of the company. Okay, so how do I calculate inventory days? Which is your inventory divided by cost of goods sold into 365. Okay, will tell me how much of inventory is left. So if I say that inventory days is around 20, then 20 days, then I have to replenish again my inventory in 20 days to fulfill my orders. Okay, next is my receivable days. That is again receivables divided by revenue into 365. So it tells me for how many days I have not been paid. So while I have raised the invoices, I have sold the goods, but I have not received the cash in hand. So say my receivable days is 60 days, then after selling the goods for 60 days, I have not received any cash from the client, from the buyer, right? Then what are my payable days? Payable days are payables divided by COGS into 365. It again tells me for how many days I haven't paid my vendors or suppliers. Okay, and how do I find the working capital cycle? It is your inventory days plus receivable days minus payable days. Okay, what is working capital cycle? It tells me in how many days starting from my buying of raw materials to getting my money from the buyer, the end-to-end cycle. What is the days? What is the gap? Okay, so say I have bought my inventory today. Okay, I have produced and the goods were sold after say 30 days to a buyer. After 30 days, say the buyer will pay me after 60 days when I sold the goods. Okay, so I have spent my money on inventory. I have produced it. I took 30 days to produce, manufacture, and when I sold, after 60 days I will get the money. So from the day I have spent the money to the day I receive, it is what, 30 plus 60, that is 90. But also say I have extended my payments to my vendors for 40 days. So when I buy my raw material, I am immediately not paying the vendors. Okay, I am paying them after 40 days. Then for those 40 days, I have the cash with me, right? Because I am not immediately paying. So take my inventory 30, my receivables 60, and I'm saying that okay, after 90 days I'm receiving the money. Also after 40 days I am paying the vendors. So for actually 50 days I don't have the cash, not 90 days, right? Because I have also extended my payments to the vendors. So for that 40 days I have the cash, but it will take 50 more days to receive the cash from my buyer. So for those 50 days I am out of cash, and that is where the supply chain financing comes into picture. Okay, All right, let's go to the next financial statements, that is the cash flow statement, and it is also known as the truth test. Okay, so let me say this again. A company can be profitable and still be cash starved. Okay, because profit is an accounting construct. Okay, but what is real? The cash is real. So the cash flow statement will show you actually what is happening to the money. Fine. So the cash flow from operations, this is the net profit adjusted for non-cash items like depreciation and amortization. Okay, plus if there are any changes in the working capital. Okay, so if my debtors are going up, then it's a cash outflow, right? If money is going out to fund the receivables not coming in, then it's a cash outflow. If my creditors are going up, then it's a cash inflow, because the company is using supplier credit, right? It is not immediately paying. Now what is the key signal? So if my CFO is positive, which means the business funds itself from operations. Okay, and that is the healthiest thing you can see. Okay, now the next is my cash flow from investing. So any capital expenditure, for example purchase of plant or machinery, or any capex, okay, or if there are any proceeds from sale of assets, or if you have any loans to subsidiaries, okay, these will all come under your cash flow from investing. So if the consistently it is negative, then it is a healthy signal, which means the business is growing and investing in capex. Okay, the next is your cash flow from financing, or the proceeds or repayment of your short term or long term borrowings, or if there are any equity raised, if there are any dividends paid. Okay, so if the company is constantly drawing a cash flow from financing to fund its operations, then it is a red flag. Okay, so now let me give you the 4 SCF specific signals from the cash flow statement, right? Signal 1 is that your CFO is negative for 2 or more consecutive years. Okay, so this suggests that the business is stretching its supply payments. Then trades becomes urgent, okay, but it's also risky, because the company is not generating cash and it will not be able to service its interest and debt, right? Signal 2, large increase in debtors in the CFO, which is your receivables are piling up, right? So it will be a receivable financing opportunity, but again you need to be very careful. If it is huge, then it might not be able to service its debt, because actually it is not receiving any cash. Signal 3 is your high cash flow from investing. Okay, so the business is debt funded, it's through its working capital, right? And a trades product can reduce this by giving cheaper early payment option to suppliers, and that will free up its credit lines, right? And then there is signal 4, which is strong cash flow from operations with excessive cash, and if there is low short-term debt, then what do you pitch to the client? You pitch your dynamic discounting, because the client has enough cash sitting on its balance sheet, right? And it can deploy its cash to pay the suppliers at a discount and earn that arbitrage, right? So this was about the 3 statements. I hope it has helped you understand the each components and also map the different products by understanding the gap in these statements. Okay, Thank you.